Hi, it's Ashik here. Welcome back to my channel. Our today's lesson is bank reconciliation statement. Many students do not understand this chapter. In this video, I'll explain you the basic and concept of this chapter. Because if you have the foundation of bank reconciliation statement, whatever question is given, you'll be able to answer. So no more time wasting, let's get started. So what is bank reconciliation statement? Before this, we need to clear a couple of things. What is a cash book?
A cash book is a ledger which includes all cash receipts and disbursements, including bank deposits and withdrawals. The cash account and the bank account appear side by side in the cash book.
And what is bank statement?
A bank statement is a copy of the customer's account in the book of the bank. A bank will send a statement at a regular interval to its customers detailing the transactions.
Now, what is bank reconciliation statement?
It is a statement shows that on a certain date the bank account in the cash book and the bank statement balances were reconciled. It does not form part of double entry record of the business.
Basic must be cleared. So here, two columns, cash and bank in the debit side, cash and bank in the credit side. But when we prepare this BRS, we do not consider the balance of cash book in the cash column. We have to consider only the balance in the bank column, okay? Bank statement will be produced by the bank and cash book will be done by the business, okay? And business records all the transactions in the cash book. Bank records all the transactions in the bank statement. Now, when bank reconciliation statement is prepared, it depends on the volume of the transactions. Business those have lot of transactions may prepare bank reconciliation statements every day, once in a week or twice in a week. Business those have the less transactions may produce the bank reconciliation statements once in a month. But most business prepares BRS at the end of every month. But why does a business prepare this bank reconciliation statement? Answer is simple: match up. What to match up? You might be wondering what to match up. Yes, match up the balance of cash book to the balance of bank statement. So who prepares the cash book? Business prepares the cash book. Business keeps all the records of cash transaction here in the cash book. Same transactions bank records in the bank statement. But at the end of the certain period, the balance of cash book and bank statement are not same. Look at here. Cash book balances is $5,000 in the debit side. That means this is the asset. Okay. At the same time, bank statement balance is $4,000. So two different balances. So why it happens? There are three reasons. Number one is here omission, then timing. Number three is errors. What is omission? Like dishonored check. Any kind of payment is made by the check, but check was dishonored, which is not recorded. Bank charges any kinds of fees, but this cash book, the accountant of the business does not know, not recorded. Bank interest, bank credited interest to the business bank account, but not recorded there. Missing, any kinds of receipts are missing in the bank, so not recorded in the cash book. At the same time, timing differences. What is this? Check issued by the business but not debited to the bank. So business paid money to the supplier by check. So that check was not presented to the bank to collect. So, and then check deposited but not yet credited to the bank account. Business got a check from the customer and recorded in the cash book and sent it to the bank to collect the money. But money is not yet credited, means collected. So there is a difference between cash book and bank statement. Once again, whatever transactions are entered in the cash book, same transactions with the same value are entered in the bank statement. But difference occurs. Okay, then what is next? Number 3, errors. So errors happen in the business or in the bank. Okay, so error in the cash book, maybe accountant made mistake in the business to make a transaction in the cash book. Maybe bank made mistake in the bank statement. So for the errors, so this difference may occur. So what to do? You need to reconcile now the balances. So before that, students are very confused about this, about 2 terms. Which are this? Number 1 is deposit, number 2 is issued. Okay, what do you mean by deposit? Students think that deposit means money goes out to the bank. We write in the credit side. No, deposit means you received check from the customer. Okay, you enter in the debit side. This is your asset. Entering the debit side means your cash is increasing, means your asset is increasing. At the same time, same deposit bank records in the credit side, because bank keeps our money to safeguard. Okay, and this is the liability of the bank, but this value is the asset for the business. Okay, when liability increase in the business, bank records in the credit side. When asset increase in the business, record in the debit side. Okay, so these things you need to understand first of all. Then issued. When check is issued, bank paid. Check goes out, money goes out from the business bank account. So first of all, business will record this transaction in the credit side, because money paid, asset will be decreasing. Bank balance will be decreasing. That's why business has to record in the credit side. At the same time, bank will record in the debit side. So now you understand the debit transactions of the cash book will be recorded in the credit side of the bank statement. At the same time, the debit transactions will be, of bank statement will be recorded in the credit side of the cash book. So these transactions must be same, but reality is different. I said that balances are not same. That is why business has to prepare this bank reconciliation statement. Okay, then items appear in the bank statement. Okay, bank statement is also called passbook. Okay, passbook. Okay, passbook and bank statement same. So look here, items appear in the bank statement or passbook, but not in the cash book. These are the items here basically appears in the bank statement, but business does not know. That's why these are not recorded in the cash book. So what are these? Interest, bank charges, direct deposits, bills for collection, interest or dividend collected by the bank. On behalf of you, bank collected the interest for the investment or any kinds of dividend of the shares, but your business does not know, business did not record that. Or business charges this any kinds of fees or credited to the any kinds of interest, that is not recorded in the cash book. Okay, so these are actually appears in the bank statement. Okay, so as these are appears in the bank statement, not appeared in the cash book, so mistake difference may occur. So need to prepare this BRS to reconcile. At the same time, some items appear in the cash book but not in the bank statement. So look at here, these are the items will be appeared in the cash book. This will not appear in the bank statement. That is why differences between these two appears. Okay. So what items appear in the cash book? Check issued by the business. So business check issued, business recorded in the credit side. That means asset is decreasing. Already business recorded that one. But this credit item did not go in the debit side of bank statement. Means bank did not record. To clear the check, bank takes 2-3 days. Okay, this will appear in the bank statement 2-3 days later. So that is why there is a timing difference, and for this timing difference, the balances are also different. Okay, then what? Check deposited but not credited by the bank. Check deposited means your asset increased. You recorded in the debit side of the cash book. But this is not credited, means did not record in the credit side of the bank statement. Same for timing reason. Today you deposited, after 3-4 days it will be credited to the bank statement. So for this time there will be difference between bank cash book and bank statement. Okay. So then what? Standing orders. Okay, what is standing orders? Like you ordered, you give the instruction to the bank that on that day you will pay this money to that company, that businessman, that charity fund, that for that purpose. Bank will do however you instructed. But the accountant of the business did not record that one. Okay. And then what is next one? Errors. Any kinds of errors made by the business accountant in the cash book. That is why the differences will occur. So when your basics are cleared, whatever question is given, you will be able to answer. Okay, so there are two ways to prepare this BRS. Okay, number one, you can start your BRS with the balance of cash. Okay, here cash balance is 5,000 for example. So you start this balance. Now you adjust this all the errors here or transactions here. Then you will arrive at the balance of bank statement. Or if you think that no, you will start preparing this BRS with the balance of bank statement. No problem, you can do this. You write this balance here first of all, then you record all the discrepancies. You will arrive at the balance of cash book. So this is all about our today's lesson. I hope you understood the basic of this bank reconciliation statement. In my next video, I will show you how to prepare the bank reconciliation statement with a practical question. Okay, and until then, you stay safe, take care. Bye bye. See you soon.